Hey guys, today we're going to discuss a topic that concerns everyone who's just starting out in the field of automated trading, namely which assets are best to trade. Because in MetaTrader 5 today, we have everything: currency pairs, metals, oil, indices, stocks, cryptocurrencies, and even coffee and cotton. And the logical question is, where among all these is it best to run a trading bot? Well, first, let's clarify one important point. All these assets are not physical assets, but CFDs, contracts for difference. We talked about this financial instrument in the previous video lesson. These contracts allow us to speculate on price changes of assets without physically buying these goods. This means that you're not physically buying gold, oil, or for example, Apple shares. You are simply trading on the price difference. So it doesn't matter what exactly you are trading, currency, metal, or a stock index. The only thing that matters is how predictable the price behavior is and how well our expert advisor can adapt to this asset. Guys, now let's look at the question of which assets are best suited. So, for automated trading, I always recommend choosing predictable assets with a long price history and high liquidity. The classic choice is currency pairs. These are, for example, the euro against the US dollar, the British pound against the dollar, the Japanese yen against the dollar, the Australian dollar, and the New Zealand dollar against the US dollar. In other words, such currency pairs have a long price history and predictable price behavior, which can be analyzed using technical indicators and technical analysis. The second asset I recommend for trading is gold. It is one of the best assets for algorithmic trading, with a clear trend structure, strong impulses, and constant activity. Gold is like the Ferrari of the CFD world. It can be volatile, but that's exactly where its strength lies. There is also another group of assets you can trade. These are commodities and indices. For example, oil, silver, and stock indices such as Nasdaq or the S&P 500. All of these are great options if you understand their behavior and set your risk correctly. And of course, if your trading bot is trained to trade on that asset. These assets have good liquidity and a more or less predictable price movement dynamic. Now guys, let's talk about which assets are best to avoid. Let's be honest, if you're just starting out, there's no need to jump at everything that moves. You need to be especially careful with young assets, for example, new cryptocurrencies that have no price history at all. Their price charts are erratic and liquidity is very weak. With such assets, an expert advisor, and we're talking about automated trading here, simply doesn't have enough data to learn how to trade on them. And just buying an asset in the hope that its price will go up, guys, that's not for us. As I mentioned in one of the previous lessons, this approach means that we can quite easily run into something like what is known as a crypto winter or an economic downturn, which is a period when the price charts of our trading assets just sink and we have to wait, sometimes for as long as 6 months or even up to a year, for them to recover and start growing again. That's why investment trading is not for us. We're talking about automated trading, where we trade in both directions, making both buy and sell trades. That's why we're talking about CFD contracts now, not just buying and waiting. So, to create a reliable algorithm, you need years of historical data. And ideally, the assets should have already gone through several different market phases, surges, declines, sideways movements, crises, and recoveries. Without this, the expert advisor simply won't be able to learn and trade effectively in the future. That's why we only choose assets that have stood the test of time. Choosing an asset is a matter of pragmatism. A trader doesn't care what they're trading, euros, gold, or oil. We're only interested in the results because we're not physically buying the assets. We trade only with CFD contracts, which are digital contracts, for the difference in price. So there's no need to fall for the hype. You can't equate a popular asset with a profitable asset. That's why we only choose those assets where we know for sure that the expert advisor will be profitable. We shouldn't be concerned with any other questions when it comes to choosing an asset.